So the only sale that we had made so far in Rohan's business involved a cash sale. We're going to now look at a sale from on account, from an accounts receivable standpoint. And so this will look slightly different, but not terribly different. And don't be confused by the fact that we will not have actually received the money for this at the time the sale is made. So we've got revenue because we've made a sale. And we don't have cash though because we're not being paid for it right now. We'll be paid for it later. So we have an accounts receivable. And so we've got our delivery fees, which is our revenue account that falls under the umbrella of owner's equity. And then we have accounts receivable, which is an asset. And so we have increases in both of these accounts. And let's look at our accounting equation. So we've got assets on the left side of $600 increased, and we have another $600 in revenue that falls within the umbrella of owner's equity, and we remain in balance. It's a good thing. And if we just now look at the left side of our equation, our asset picture, let's look at where we're at now. So we finished the last transaction. We had $750 in cash. This was not a transaction that involved cash, so we still have $750. We now have a $600 accounts receivable, and we still have our $2,100 in equipment, which gives us total assets of $3,450. Now we'll look at the right side of the accounting equation. We still owe $600 on our equipment. Rohan's equity account hasn't been, it remains the same. And now we've had total revenues of $1,100, total expenses of $250. And so we have a total of $3,450 on the right side of our accounting equation, which lo and behold equals the left side. So we have proven the accounting equation correct in that our assets continue to equal our liabilities plus our owner's equity. So we've got yet another transaction here. We're going to buy some supplies, and we're going to spend $80 in cash for those supplies. So the first thing we do is take a step back and think to ourselves, okay, what's being impacted here? What kind of accounts are those? Our supplies are an asset. We're going to have, but anyway, supplies are an asset and cash is an asset. So in this case, just like when we bought our equipment, we're only going to be, this transaction is only going to affect the asset side of our accounting equation. Now, when we look at what accounts have increased or decreased, our supplies have increased because we now have supplies we didn't have before, but our cash has decreased because we had to spend some of it in order to get the supplies. So again, the only thing that changes here is on the left side of the accounting equation. This just impacts our asset side. So we have less cash, we have more in supplies. So it's a zero net change from where we were at before, and we don't have any impact on the liabilities or owner's equity side of things. And so again, we want to just confirm that we remain in balance and that we prove our accounting equation. So we started our accounting period with $750 in cash. We spent $80. Now we only have $670 in cash. We still have that customer that owes us $600. We now have $80 in supplies. Whoops, we didn't start with. And we still have our $2,100 in equipment for total assets of $3,450. And I'm just going to back up here a couple of slides so that you can see after the last transaction, we still had $3,450. So there was no net change in our asset position. It just shifted character a little bit. Some of our cash ended up in the form of supplies. And when we look at the owner's equity side of things, nothing changed here. We had no impact on those accounts this accounting period. So now we've got Rohan's going to pay an 8-month, he's going to have liability insurance just in case somebody slips and falls in the parking lot. Rohan's a smart guy and he's going to buy insurance. And he's going to buy 8 months worth of insurance for $200 in cash. So he's going to pay that in advance rather than paying for it on a monthly basis. So now we got to think about it in terms of what accounts are affected. Because he's paying for that insurance and we haven't actually used it, we won't use that insurance till the month goes by that insurance was purchased for. So that prepaid insurance is an asset and it won't become an expense until that month goes by. And if you think about it, if after a month or 2 weeks or whatever, if he decides he's going to cancel that insurance policy, they'll give him the money back for the months he didn't use. So that's why it's an asset, the prepaid insurance. And of course, the cash is an asset. And when we look at what is increased or decreased, we see that the prepaid insurance asset account is increased, but we decreased our cash as a result of that money going out for the premium. And again, we have only impacted the left side of the accounting equation. We've done nothing to our liabilities or owner's equity, so everything stays the same. And we still have $3,450 in assets. As a result, we now have a new account called Prepaid Insurance, $200, and we now have $200 less in cash. And once again, no changes to the liability or owner's equity side of the accounting equation. So now we've got a customer who's going to pay us some money. And the customer who put some services on account for us before is going to pay us some of those services. So we're going to receive $570 in cash for services. So what accounts are affected? Well, we already counted that service in our revenue account. We don't want to count it twice. So we've got cash coming in, so we know that that's obviously an account that's being impacted. The other account that will be impacted is the accounts receivable, because it's now going to reduce the amount of money this customer owes us. And so today he gets his partial payment, so we've got impact to our cash. But the accounts receivable will go down because the customer is going to owe us less money. So our cash goes up, accounts receivable goes down. And this is just illustrating this in numbers. And you can see that only asset accounts are impacted by this transaction, nothing on the liability and owner's equity side. Our net asset picture is still the $3,450 because we basically, our assets they're the same value, they're just in a different form. So this accounts receivable has now become cash. So our cash has gone from 470 to 1,040, and our accounts receivable went down from 600 to now only $30. And again, nothing changes on the right side of the accounting equation in terms of the liability and owner's equity. And so now we have yet another transaction. We're going to buy some more delivery equipment. And so we're going to pay cash for 300 of it, and 1,200 of it we're going to put on account. So think about which accounts might be impacted. This is a transaction that we've done before. This is really the combination of two different transactions that we've done before. So the words on account ought to automatically trigger because we are going to put it on account. It's something we are going to have to pay. So it's going to be an accounts payable. On the other hand, it's going to give us some equipment. And so that's going to be an asset account. And we're going to pay some cash out in addition. So that's going to impact our cash account. So we've got, again, our cash, our delivery equipment, and now we're going to have our accounts payable. We already had some that we owed for the last delivery equipment we still hadn't finished paying for. So we're going to increase our accounts payable by this new debt. So again, our cash goes down for the $300 that we put as a down payment. We increase the asset by the value of the equipment we purchased, the whole amount, not just the cash amount, the entire purchase amount. And then our liability is increased as well. So we've got a $300 decrease in our cash. We got $1,500 in total equipment value. And we have a $1,200 liability for that debt that we still owe. And we remain in balance. What's on the left side of the equal sign equals the right side. And so if we now look at our whole asset picture, we can see from this new transaction, our cash went down by 300. So we now have a total of 740 in cash. The only other asset account that was impacted was we now have to add in the 1,500 in delivery equipment we just bought. So now our delivery equipment total is now up to $3,600. And that gives us total assets of $4,650. And we've got to remember on the right side of the equation, our liabilities went up by that $1,200 that we now owe for that. So our liabilities are now up to $1,800, and nothing else was impacted by that transaction. So we have $4,650. Now, Rohan's a busy guy, but he's going to pay his employees $650 in wages. So what accounts are impacted? Wages are an expense, and cash is an asset. So we had an increase in expenses as a result of these wages, and our cash went down. And we still balance. So we remain the same on both sides of the equal sign. Our asset situation has now gone down by the $650 that we paid out in wages. And on the right side of the equation, we have an additional $650 in expenses to charge against our revenue. And so if we look at our liabilities, the money we owe, plus the 2,000, Rohan's 2,000, and our revenue minus our expenses gives us a total liabilities plus owner's equity figure of $4,000, which fortunately, and I'll go back, equals our assets. So we're good. Rohan continues to be busy. Now he receives delivery fees. He gets $430 in cash and $620 on account for his delivery services. So what accounts have we impacted here? We got some cash. And so some of this was also on account. So it's split between two, the cash and the accounts receivable. But the entire thing is going to be declared as revenue at the point of the sale. And so we have increases in all three of these accounts. We have 430 in cash that we didn't have yesterday, plus now we're owed $620. And we have $1,050 in delivery fees. And so 430 plus 620 equals 1,050, so we remain good. Looking at our asset picture, our assets, we had 2 asset accounts increase as a result of the cash payment and the accounts receivable. And that gives us a total of $5,050 in assets. Similarly, our revenue went up by $1,050 as a result of that sale. And so the right side of our equation is now up to $5,050 as a result of that additional $1,050 in revenue. And I'm actually going to stop here and go on to the next video where we're going to talk about Rohan's withdrawals.